Business owners are bombarded with issues and financial problems constantly. Today we're talking about how to resolve 3 of those financial problems using life insurance.
Just start saving. We're going to change your world.
What's up, folks, and welcome to the Money Summit. My name is Dallas. I'm a financial professional helping business owners and individuals achieve their financial summit. As a business owner helping business owners, I have found that there are 3 major problems that we can solve using life insurance. Problem number 1, access to capital, preferably tax-free. Problem number 2, generating or creating more income streams for us to have now and in the future when we retire. And problem number 3, what happens when I pass away? Where does the business go? What happens to the family? How do I take care of them? Diving deep into these problems, let's first talk about what life insurance actually is, and then we'll build off from there. And talking about life insurance actually will kind of resolve problem number 3. You'll understand what I mean in a moment. Life insurance at its base or at its core value is a contract between an insured or an individual or business owner and the insurance company themselves. That contract states if the insured, if it's the owner or business owner, whatever, if the insured passes away, the insurance company pays a benefit to the beneficiary based on how much the premium is and how much they want coverage. Now that we know what life insurance is, again, that kind of resolves problem number 3, but we'll go into more detail about that in a moment. Within life insurance, when talking with business owners and how to really use it to our advantage, the one thing I like to use is called an IUL. It stands for Indexed Universal Life. It is a type of permanent life insurance, which is different than a term insurance. Whole nother video talking about those differences. But a permanent insurance plan usually will generate some form of cash value, and the Index Universal Life uses different indexes within the overall stock market to capture those gains on the upside. Different providers, different agents are going to show you different averages. Most of the providers will use an S&P 500 for these gains, and the S&P 500 is probably right now the most valuable index that we can use to get those gains on the upside. So within the cash value portion of life insurance, it's going to earn interest when the market goes up, which is great. That's what we want. But when the market goes down, it's going to be level at a minimum 0%. We say 0 is your hero because I'd rather have a 0% gain than a negative return, right? We don't want to lose money. That being said, within the life insurance construct, you have the insurance value and you have the access to surrender value. There's also an accumulated value number, which we'll go more detail probably in another video, difference of accumulation and surrender value. That surrender value, as long as there is an amount in there, you have access to that money. But let's say, for example, there is $100,000 in your surrender value. You have a $500,000 policy, meaning if you were to pass away, $500,000 goes to the business or to your family. We'll talk about that in problem number 3. And you need 50 grand. So there's $100,000 in the surrender value, and you want to take 50,000 out for expanding your fleet of vehicles, for building a new branch in your business, for upgrading your software systems for the business, whatever it is. I highly recommend using it to be a productive thing, not just to blow it on, jewelry or something. So let's say you take that 50,000 out. If you were to take it out as a withdrawal, like a typical savings or retirement account, you would be taxed on any gains had, just like a CD or non-qualified account, you're taxed on the gains. If you take it out, as I prefer, against the insurance amount, so it's seen as a loan against the insurance amount, it is tax-free to you. This is very similar to what people do with real estate, taking money in and out and transferring funds to different homes and loaning out against it. That's tax-free. The difference is, in that scenario, the bank has to get that money back because it's a loan with a bank, whereas with the life insurance, it will just come out of the insurance when you pass away. So we're leveraging the life insurance while you're alive. So you get that 50,000, the $500,000 that you had in insurance is now down to 450,000, but you got that 50,000 from the surrender value tax-free. And you can go and use that 50,000 for whatever it is that you're trying to accomplish, right? That helps us solve problem number 1, access to capital, having liquid cash that gives us a tax-free benefit, of course, and in addition to using it for whatever it is that we're wanting to do, whilst getting more than what a savings at a bank account would give you, right? In addition to that, probably my favorite strategy or problem to solve using life insurance is generating or increasing income for the future. A lot of business owners don't think about it because they're thinking about now. They're thinking about how do I help my business? How do I help my clients? How do I help my employees? They really don't think about what kind of income am I going to have for the future. And we're all really hoping deep down inside that the business grows and that we sell it and we just have millions sitting in the bank, tens of millions of dollars just to live on for the rest of our lives, or we really don't ever really plan on retiring at all. That all being said, there is something to be said about having an additional guaranteed income stream tax-free, similar to problem number one, right? Tax-free income that lasts you for the rest of your life. To help explain problem number two, I want to give you an example of what I've actually done to help a client to kind of help you understand how it works and what the benefits are. So I have a lot of different clients, quite a few of which are realtors or in the real estate business to some capacity. And this particular individual that I'm thinking about, and I'm using loose numbers and terminologies here because I don't want to reveal anything, but this gives you an idea, right? This particular individual, we're looking to do up to $100,000 a year. That could be anywhere from $50,000 to $100,000 a year, maybe a little bit more, but you know, 70, 80, probably 1,000 a year, setting aside specifically into this account to, for one, take care of problem number one, like we talked about, and then to have a guaranteed income for the future, fixing problem number two. So if they were to do $65,000 across the board, specifically for the retirement portion into this IUL, $65,000 for 20 years, that's going to pay them almost $200,000 a year, roughly at the age of 65, for the rest of their life. And that would be tax-free because we're using it against the insurance like we talked about with problem number one. So they would be receiving approximately $196,000, almost $200,000 every year for the rest of their life. Now, if they were to take some of that out and use it for other income streams, other rental properties, whatever it is, they would have the income from that, and then maybe they would only get $120,000 a year instead of $200,000. But it's still income from the real estate, income from the tax-free IUL. There's still many options that they are achieving income streams by having the IUL in place. So you can add money to it. It's going to earn interest on the upside of the market. And in the end, you can stop making contributions, unlike most permanent life insurance plans. And in return, it's going to pay you a guaranteed income against the insurance amount for the rest of your life. And while I'm explaining all this, I know there's a lot of terminologies and potentially a lot of difficulties, maybe not really understanding what I'm saying. If you have any questions, please put them in the comments. I'll be more than happy to help you. And if you really want to learn, there's also a link in the description to get on my calendar and we'll talk one-on-one. No cost to you. Let's talk about what your questions are and how you can actually use some of this for you and your business and your family. All that leads us to problem number three, which kind of references the beginning of the conversation of life insurance in its purest form. A lot of times business owners, we get ahead of ourselves. We don't really think about what happens if we leave and what happens if we're suddenly gone from this world. And there's a lot of financial hardship left behind if we leave the business and or our family all of a sudden, right? So at its core, there is always an insurance amount. Even if you've taken money against it, there is always going to be an insurance amount unless you've canceled the policy. There will be a benefit that will pass on to the beneficiary. Now you can have the business as a beneficiary to help with business costs to keep the ball rolling within the business. You can have a portion of that going towards your family. You can have a trust as the beneficiary. And within the trust, now I'm not a trust attorney, so I can't tell you all the details about trust, but within the trust, you can dictate who gets what, when, where, and why. You can go into very, very minute details about what that money does. And that's probably, I mean, if you have a family and you own a home and anything else that you own, you want to have a trust in place. I don't do trust, but we have people that we work with. Be more than happy to link you up with them. But you want to have a trust in place, and you want to have the beneficiary of the life insurance be the trust. And within the trust, you could dictate who gets what, when, where, and why. So that all being said, that covers the three major problems that I have found being a business owner, helping business owners to achieve their financial summit. Like I said, if you have any questions, put them in the comments down below. Thanks for joining. We'll see you on the next one.